what stands out for you as the biggest deals of the year?
Biggest deals of the year are clearly the Origin deal that's just been announced.
Yes.
In terms of dollars.
That's right.
$18 billion enterprise value deals. That's huge and not really expected. So I think that surprised the market. I think in terms of scandals and something that every listed company has to take into account is the whole cyber security.
Yeah, so that's Medibank Private.
Correct.
And then before then, Optus.
Yeah.
But then the interesting thing is, when you go to that energy space, you had so many deals. You had Andrew Forrest and his private company taking on CWP, $4 billion there. And then on top of that, of course, you had Mike Cannon-Brookes and his Grok venture. Originally, the interesting thing about that was you had Brookfield originally bidding in tandem with him to take over Australia's largest and oldest energy company, AGL Energy. And then Adam, of course, Brookfield then backs out and goes and takes over Origin, which is, the real surprise. There's a massive shake-up there at a time when the energy industry seems to be almost in crisis in this country.
It's definitely in crisis, and the government's definitely stepping in, as we're seeing right at the moment. But the reason why I think Brookfield did walk away from AGL was the energy transition period that AGL was going to be able to become fully renewable was a lot longer than Origin. So they went to Origin and they said, can you do this by 2030, 2050? When can you do this? Origin said, yes, we can. AGL still had that legacy Loy Yang coal power plant. They had all of these different legacy issues and they couldn't get that transition in time. So Brookfield walked away, went to Origin, put a thumper table, a bid on there. Potentially, is it going to go happen? I'm not too sure because I've got FIRB, Foreign Investment Review Board, which I think they're going to be really struggling to get that across the line due to the fact that energy is such a ridiculous political football right at the moment.
Well, it really is. And the other aspect of this, Catherine, really in some ways, it was almost the year where private equity almost took over. And it's almost the patient capital now. And even some of our biggest super funds are now becoming very active participants directly in Australian public companies.
Yeah, we've seen that. Obviously, last year's was Sydney Airport. That was another, big deal that happened as well. And there's no doubt it'll be interesting next year how it all turns out with these super funds because we've taken a lot of the pain in the stock market this year, particularly on the industrial side. We haven't seen it come through yet on the unlisted side. So it'll be interesting to see how some of those mark-to-markets of those private investments come through.
And really what is absolutely no doubt is the movement in the market, the big lurch downwards, was all about the interest rate story.
Correct.
So as a result, the yields suddenly blow out on property and on shares. And so the valuations come off big time. Now, this obviously led to superannuation funds, funds managers having a tougher time to find that value, but also if they were cashed up, to be able to extract some value for the future.
Yeah, exactly, Ross.
I've turned it exactly. So what did you buy then in that case over the past 12 months?
Oh, look, we've been selective on the industrial side. Resources obviously have been the big winners of 2022, particularly in the last couple of months.
And particularly coal companies.
Coal, unbelievable. Coal, LNG and lithium. That's been the story.
So we were looking the other day at some of the top performing companies and you're just going to go through them all. Yancoal is there, Stanmore is there. What's the other big one?
Whitehaven was the
Whitehaven was the massive one, right? So all of these coal companies that at one stage you literally, Adam, could not have given away, suddenly became the great performers of 2022.
And one of the things that Whitehaven has done fantastically is that they've said, we're going to reduce our dividends, but we're going to continue to buy back our stock. And they're going to literally buy back up until the 31st of December. And then there's another program that's going to go into the January, February, March period where they're going to continue to buy back stock. It's going to be around about 30% of their overall shareholder base is going to be bought back in the next 6 months. And when you look at that from an NPV valuation, that means that obviously shares are going to continue to stay higher for longer because their earnings is going to continue as well. So as long as the coal price stays where it is, and we think it will, it will be a fantastic bonanza for all coal holders, shareholders going forward.
But then we go to another energy story this year, which was one of the biggest deals of the year, there's no doubt, and that is the BHP Woodside deal that went through. Now, for BHP to suddenly say, we don't want energy and gas anymore, we're going to be prepared to stick on these other fundamental issues, including iron ore, including some of the phosphates and so forth to feed the world. So they were really about the future metals as well, leaving Woodside to become one of the largest energy companies in the world.
Yeah, and also one of the best performing stocks this year.
Yeah.
Yeah, because it also found itself with about 25% of the gas that they could sell into the spot market to take advantage of that Asian LNG price that went, spiked up towards $40.
And that was also exacerbated when Ukraine was invaded by Russia. And so as a result, the world needed gas, and it didn't matter where that gas came from. They were prepared to transport it to overcome any of the energy shortages that could take place during the winter. So you're right, spot markets went berserk. It didn't matter whether you sold it into Asia or whether you get it into Europe, it was going to get a pretty big premium at that time.
Yeah, which is the same as the coal price. They're all interlinked.
Yep. OK, so then on that subject, which is Russia-Ukraine, go to agriculture stocks. They have had a bumper time, Adam, over the past 12 months.
Well, it's obviously helped that we've had some fantastic rains through the winter period and now coming into the summer period. That ABARES came out with a report on GrainCorp basically saying it's the best it's ever been, and it's probably the best it's ever going to get for the weather patterns that are happening at the moment. But absolutely right. Ukraine, I think, was the third largest producer of grain across Europe. They had to then find somebody else to fix or to find supply. And that's where Australia definitely came in. And that's what's kept these grain prices moving higher and doing very well going forward. OK, so that's one part of that story. And of course, the whole feeding of the nation and the floods that you talk about, and therefore really good rains in many parts of Australia. But the floods clearly caused devastation to many parts of Australia. Insurance companies were not immune from that, were they?
No, they've seen record claims this year, unfortunately for them. But interestingly, we're at the end of the La Nina weather pattern. So in terms of insurance claims, they've had a horror 3 years, right, for the insurance. And actually just in the last couple of months, you've started seeing their share prices improve. So they may be a sector in 23 that does well. All
right, so that being the case, have you climbed into them in a little way?
We've been doing some more research.
Have you been selecting?
Some more research.
Well, I like that, Jeff. That's very good.
Well, I think the reason why the insurance companies did so well also was higher interest rates means that a lot of that money that they've got sitting on the sidelines is going to earn them more interest or more money.
Investment income.
And hence that's why the insurance companies have really started to tick up and get a bid over the last couple of times. A lot of people have talked to me about QBE, but always a perennial disappointer, and I'm not getting my fingers burnt this time around, albeit it does look quite good for the insurance businesses at the moment.
OK, because you're right, it has been a perennial disappointer. But I want to go to that whole issue of raising interest rates. The Reserve Bank had done this consistently. The idea was to try and quell the consumer demand. Now, let's be honest, when it came to airlines, there was no quelling of consumer demand. Qantas, the turnaround of Qantas has to be one of the most impressive stories of the year, but one of the most impressive turnarounds of any company we've ever seen.
Yeah, because you've seen a rational industry structure with Virgin and Qantas. Rex has got about 2% of the market, so they're pretty irrelevant. And then Qantas has got, 70%, and then Virgin has the rest. So they've been a huge beneficiary of what's happened over the last couple of years. And clearly we're all paying for it in terms of prices, but we all want to travel, right? So they're all benefiting.
But to turn around would have been a record loss, billions upon billions of dollars, to suddenly say to the market, well, actually, we might make $1.5 billion this year.
And a buyback.
Yeah. So all of that meant that really, in many ways, though consumers might have been grumbling about the price increases, the fact is that Qantas could manage its capacity. It could actually, therefore, manage price. And oddly enough, long term, that's not a bad thing, because as soon as we start to think, well, OK, $600 or $700 to go Melbourne, Sydney, Brisbane, wherever it might be, or more to go to Perth. Well, under those circumstances, if we kind of get used to that idea, well, that's going to stick around for a while for them.
Well, as soon as they raise the prices, do you ever see it go backwards? Anyway, but I think there's a lot of pent-up demand from COVID that people couldn't travel, couldn't do things, so they've had these vouchers. That's all now starting to work its way through the system. I do feel that next year the airline prices, tickets will start to reduce a little bit, but the demand will still be there for those flights. Sydney and Melbourne is the second or third busiest route in the world. We're always moving backwards and forwards between those two cities. And these airlines are definitely taking advantage of that. OK, so Catherine, move your head forward into next year. What I've wondered, and even with our economics panel, we're having a chat about that, whether there's a brick wall out there, a brick wall for consumers when energy prices and when interest rates catch up with them. Their consumer demand is subdued.
which means that affects companies' earnings and sales, which therefore potentially affects the markets. Now, oddly enough, the market's been buoyed by falling interest rates. At some time, they stop as well. So what I'm wondering is whether there's a bit of a black hole for the market and maybe even for corporate Australia going out into 2023.
Well, definitely, if we went back 6 months ago, we sort of thought that it was going to hit in the half we're in now. It actually probably is not going to hit till mid-year next year, is what the banks tell me in terms of when they look. And they say the biggest thing that we've all underestimated is the actual wage increases that we've seen this year. And that's hitting, obviously, people's accounts as well. So nominally, people aren't doing too badly. And then the mortgage rate increases always come through with a lag of somewhere between 30 and 60 days. So they're still putting through those mortgage rates coming through. But I agree with you. You know, energy prices are yet to come up. Cost of living pressures are everywhere. Food prices are up. So, and then now clearly the interest rates will hit their mortgages.
So is that a reason for people to be a little wary as to what happens in markets? And certainly that earnings period leading into August, that could be the one that people might need to watch.
Yeah, I clearly think that in February, corporates will be calling out the next 6 to 12 months will be more difficult in terms of the consumer. So we will see that, and people are wary. But is it priced, right? Retail stocks have been down like 25% this year. And so the question is, they're all trading on pretty low multiples. So any sort of surprise on the upside, those stocks seem to, to rise and get through. But it will be an interesting year next year, Ross.
There you go. Adam, what's your own feeling on that?
Look, I think overall, if you look at this Christmas, it's going to be the best Christmas that we've had in 2 years. No travel restrictions, no issues. Everyone's going to get together. They're not going to worry about next year. We're all going to have the hangover, which is going to happen next year. And that hangover is exactly what we're talking about. We're a little bit concerned of how those numbers are going to look. Consumers' discretionary stocks, potentially with higher interest rates, inflation is going to continue to come down. It's going to be sticky though, and I think it's going to be relatively high. And as we see this inflation coming off, it's not going to be down at 2 and 3% anymore. I think it's going to be a little bit higher, and that's what I think is going to concern the markets, is that it's going to be stubbornly high for longer, which means that central banks are going to have to readjust their positions going forward. That causes uncertainty. I think it's going to be a tough year for 2023.
Adam Dawes, Catherine Allfrey, thank you so much for lending me your brain today, and have a wonderful 2023.
Thanks, Ross.